Awesome stuff there from the team at New Vista. We really appreciate them taking the time to present here at the Oil and Gas Conference. I am Michael Tanner with Oil and Gas 360 as a correspondent. Excited to be announcing our next speaker, who is Matt Haggerty, a senior energy analyst with BTU Analytics. BTU Analytics combines fundamental analysis with upstream research to offer insights and valuable intelligence to investors at all levels. They're a Lakewood-based company right here in Colorado. Matt Haggerty is going to be presenting on sort of what BTU thinks the outlook is going on, and then me and him are actually going to come back together and do a quick little Q&A. Excited for this conversation, and I'm going to go ahead and turn it over to Matt to kick it off.
All righty. Good morning, everybody, or good afternoon, good evening. We are, recording this presentation a little bit ahead of time, given the current situation across the globe. But my name is Matt Haggerty. I am a senior energy analyst at BTU Analytics, and today I'm going to be discussing how economics and the pace of the oil recovery is going to dictate some of the gas-focused activity and what some of the moving pieces are on the oil side of things. So looking at what are some of the moving parts and how economics will impact that recovery. So if you are not aware of BTU Analytics or what we do, we provide data-driven analysis in the energy markets, whether that be oil, natural gas, NGL, or the power markets, to really help answer some of those difficult questions around where the market is going, what pieces are going to move within that. So just in terms of what some of our product offerings are, in addition to offering bespoke consulting analysis, we also have a number of products that are available. Now we have a number of those related to both the upstream, midstream, and downstream sectors in the energy markets. However, a lot of what I'm going to be referencing today is in reference to our Oil and Gas View, which is an interactive web software where you can really slice and dice economic data, production data, and well data pretty much however you see fit. And just getting started, at this for this presentation right at the beginning, we do have this cautionary statement, which you can review on your own time. But without further ado, I will go ahead and get started with today's presentation. So first off, to discuss just kind of where we find ourselves today. When we look back at the last 7 months of the year, there have been a number of twists and turns. And while the bottom in those scenarios has likely been reached in terms of oil demand, that path to recovery that we see ourselves on is uncertain. Reaching back to where those previous highs were from oil demand, from LNG demand, really across the energy sector. And so we will discuss what our views are around that path to recovery, in addition to what some of those moving pieces are and how that impacts some of the players in that market. And so while, when we think about this from an upstream perspective and how really the global stage and global demand impacts the oil producers here in the US, WTI pricing still finds itself well below the economics necessary or the pricing necessary to incentivize producers to drill and complete the next well. However, that does have some caveats to it. And one of those being the fact that we've seen a large duck build, especially in areas like the Permian, since the crash that we saw in late March into late April, as well as pricing turned negative. So given that we have this large duck build, that changes the economics for some producers. Because you have this sunk capital cost already, then deciding to complete that next well requires a lower price, and it's a different economic decision than if you had to drill and complete that well, given the sunk cost. So while this crude pricing does remain low, and how this recovery begins to develop, where producers decide to send that capital or to distribute that capital is not going to be felt equally between the plays. So producers will likely turn towards lower break-even acreage, which could add some additional cash flow to inflowing into their pockets. But on top of that, these lower break-even acreage and lower break-even locations that producers are likely to turn to, that will typically add more volumes, add more oil volumes than just your average well. And so I've got a few slides on that, just looking at what are some of the implications of if producers do decide to high grade their acreage, what that may mean for some of the flows that then impact some of the midstream producers. Now, talking about this oil recovery and really the pace that we have in our base case to build through this oil recovery that we're finding ourselves in the early stages of now, how that recovery develops will have significant impacts and in part dictate the recovery that we see from gas-focused producers. So combined with how we view LNG exports developing over the next several years, what happens to oil volumes and oil-focused activity and therefore associated gas will also drive the activity necessary to meet that delta in demand in gas plays, and specifically in near Gulf regions like the Haynesville. However, despite some of the LNG declines that we've seen from demand at the Gulf Coast and demand for those exports, production declines are expected to keep pace with those demand drops and leaves U.S. storage for this year essentially near normal levels going into winter. However, with some of that winter demand coupled with the declining U.S. production, we expect to see natural gas prices rise, and we are already seeing them somewhat on that path so far, but rise to be much higher in 2021. Now, again, as we just start to discuss where we find ourselves today, immediately following the shutdowns and the mass spreading of COVID-19 globally and in the U.S., we saw a rapid decline in U.S. refining runs earlier this year in late 1Q, early 2Q. And that's what you can really see on this chart here, where that dark blue line represents U.S. refining net inputs of crude oil. And so we have seen that recover off the bottom since late April and early May. However, that has begun to top off in a sense of beginning to reach kind of this peak for at least this summer, peak of some of that demand that we've seen with some of the driving demand that has shown up. And that has averaged out over the last couple of weeks at about 84% of prior year levels. But as we think about what those refining runs mean, those refinery runs have increased well above some of the demand that we've seen domestically. And so if we then take the delta there of what's being produced in terms of refined products versus what the demand is domestically, and for what we've been able to export, looking now at crude stocks or U.S. stocks of crude and petroleum products, we've seen the headline numbers over the last several weeks that crude stocks are beginning to fall from those highs that we saw reached very rapidly towards the end of May or towards the end of April and into May. And those are beginning to decline. However, given these higher refining runs that we've seen over the last several weeks, combined with subdued demand still here domestically and abroad, we've seen refined product stocks continue on that rise. And so as refiners start to think about, we are filling up this storage fairly quickly from the refined product slate or standpoint, how we choose to move forward, whether it be crack spreads beginning to deteriorate, leading to some of those refiners beginning to cut some of their utilizations and throughput, or is it that we continue to export and risk flooding a global market that is already oversupplied? So that's really the state that we find ourselves in today of, while a bottom may have been reached in terms of demand, we are not necessarily in the clear yet and fully on the path to recovery. Taking a step back here for a second and looking at what does the global market look like. And so not only will the path of U.S. crude demand and U.S. refining help dictate some pricing, but also thinking that in terms of globally, how that'll develop over the coming years will also dictate that path of pricing recovery. So this chart here showing global liquids balances on average by quarter through 2021. From what we're modeling, when you incorporate the production declines that we model for the US and Canada and combine that with the rest of the global picture, whether it be OPEC plus cuts from Saudi Arabia, Russia, Iraq, and other major players, as we start to think about that, those cuts that OPEC plus have agreed upon lasting through the first quarter of 2022 does correspond with a significant draining of global crude storage. Now, you can see in that light blue bar there what storage or what global balances would look like had we not had that OPEC deal, and essentially it would create a scenario where tank tops are reached very rapidly in the second quarter of this year. However, that pace going forward from today, from really the beginning and middle of the third quarter and beyond, a lot of that will be dictated by the level of compliance among OPEC plus partners. So, for example, with Iraq deciding to increase cuts above what they're currently quoted at in order to make up retroactively for some of the lack of compliance that they've previously had, that will be a significant moving part in terms of how we recover going forward. And other nations that matter in this equation are also Nigeria and Russia, because those two countries as well have historically struggled with compliance. But in any sense, we have seen a pricing recovery so far from those lows that we saw in April, when pricing turned negative on April 20th and then subsequently rising from there. We still find ourselves in a WTI scenario that is far below what producers need in order to incentivize drilling and completing the next well. And so you can see from this chart, which that red dotted line is average monthly WTI, paired with the average break-evens, wellhead break-evens that we see across major oil-focused basins in the US. You can see here that really the only region that falls well below what those WTI pricing is in the Eastern Eagle Ford, but given some of the operators there that are pulling capital away, or historically have pulled capital away in favor of the Permian, we still see pretty much every other region hovering at either just about WTI or well above in the case of the Bakken here. So, when these producers are thinking about, when do we start to add back activity, and when do we start to complete some of these wells, the economic decision here is not yet made yet. However, when we start to think about what has occurred over the last several months of producers quickly pulling off activity, whether that be drilling activity or completion activity, that was accompanied with a significant building of DUCs over that time frame. And so producers who, generally your drilling contract lasts for a much longer term than do some of your frac crews. So you are able, if you are trying to rapidly pull back activity, you will typically build DUCs over that time frame. And so with that capital sunk, that drilling capital sunk, when you think about a drilled but uncompleted well, the economic decision changes. And so your marginal cost to bring that well online is much lower than if you were just to start from essentially a newly spud hole and drill today and complete down the road. And so as we think about how these DUCs will play into activity and production going forward, this chart here really just details how the break-evens and how the economics change as we start to alter that drilled but incomplete, as we start to add in those drilled but uncompleted wells. So this chart shows for in each 4 bars, they are the exact same wells. However, if you flex the cost of that drilling and completion spending, that obviously changes your break-evens. And so if you are drilling and completing a wholly new well via that full D&C spend, these are for a group of wells in the Permian, you can expect that your break-even is about $42, $43. However, if you are thinking about completing a DUC, thinking about completing a well that has previously been drilled, whether it be in 2019 or early 2020, that changes your marginal spend, your marginal capex. And so as these producers start to factor that in, when you have typically about a third of your D&C spend is on the drilling side, you have about 2/3 of that extra cost or that extra spend to make up in order to bring that well online. And so as we think somewhere between that 75% of D&C bar or that 50% D&C bar, somewhere between that would essentially be your economics of those ducks. And so kind of put a different way is if we look at all of the wells completed from 2019 to present across these basins, and if we alter that drilling and completion budget by, whether we assume that all of those wells were drilled and completed as part of the same equation, or whether they are a drilled but uncompleted well, that then you are deciding through 2/3 of your essential CapEx spend, the economics change. And so just taking from the top two bars there from the Delaware and then the Delaware Ducks, the economic decision points to whether if you are completing just a Delaware well, you're drilling a new Delaware well and completing it down the road, about 30% of your wells will break even below $40. However, if you are a producer deciding whether or not to complete a duck in the Delaware, instead it turns to 65+% of those wells completed in 2019 and beyond break even below $40. So essentially, it doubles the amount of wells that we've calculated, doubles the amount of wells that break even below $40. So as we have this significant duck build, and it also depends on where that duck build is regionally and who owns those ducks, that changes significantly the economics and the decision making behind whether or not to complete that well. So for example, we got this, for us, it was yesterday when Occidental reported earnings. They pointed to the fact that in the DJ for the remainder of the year, they will not run any rigs. However, they have between 35 and 45 wells that are ducks that they plan on completing over that time frame. So it signals that they are reaching an economic standpoint and a pricing standpoint where they can, where it does incentivize them to complete their ducks. However, it does not incentivize them bringing back on some of that drilling activity. And so this really flows through our entire forecast for the next year, year and a half. And so as we start to think about in the US, this drilling, this horizontal drilling and well to sale activity, that lighter bar there, that is the path of wells turned in line that we model for the entire US. And then that darker line refers to the wells that we model will be drilled over that same time frame through 2025 here. And so in that period from essentially your fourth quarter 2020 and then beyond into really through 2021 here, we model that we will see wells turned in line far and above that which is being drilled. So essentially the ducks that you built earlier this year and when, as drilling activity slowly ticked down to reach its, most likely bottom here recently, now we're starting to draw on that duck build throughout the remainder of this year and then into next year as well. And so that thesis of the economics being fundamentally different for a duck versus what we see for a newly drilled well and then completed thereafter, that difference in those economics is what's driving our near-term production forecast. And so again, it matters where these ducks are regionally and who has them. And so what we saw with significant activity in the Permian, we saw a significant duck build there. And so we modeled that far and away the Permian is going to have this largest duck build to draw on, and therefore we'll see some sustained completion activity here through the rest of the year and into next. And so on top of that, on top of just where these ducks are, as we start to think about where any of this activity will come from, it also depends on where the remaining locations are, where the good low break-even locations are. And so as I hinted at earlier in this presentation, we are likely to see producers high grade some of their activity in order to focus on the lowest break-even locations that they may have. And so as we start to think about regionally where this may come from, again, the Permian really pops out there, especially the Delaware. So this chart here shows the undrilled locations for what's been delineated across the US, undrilled locations broken out by break-even. And so in the Delaware, we show that about 59% of remaining Delaware locations, of which has been delineated, 59% of those break even below $50. Now for the Midland, it's a little bit lower at about 39%. But as we start to think about the magnitude of these locations, with between the Delaware and Midland, we have a significant amount of undrilled locations that are low break even. That's likely to pull in some capital. And then on top of that, having the advantage of being directly connected to the Gulf Coast via a lot of the new pipelines that have been built out over the last several years, combined with the fact that for the Eagle Ford, they're directly connected, obviously, to the Gulf Coast by just being geographically so close. We model that those two regions are likely to pull in a lot of the capital in the near term as producers start to bring activity back to the U.S. Now, this chart essentially illustrates that point that I just made, but on a line chart of, as we start to think about the recovery regionally across the U.S., each region is not likely to be felt or to feel this recovery exactly the same. And so where we have the DJ and the PRB and the Bakken and Oklahoma lagging to a degree this recovery that we're modeling in the Permian and the Eagle Ford, it points to the fact that, one, we need to see higher pricing than to incentivize some activity in the DJ and PRB and the Bakken and Oklahoma than the pricing that we would need to see in the Permian, because by being directly connected to the Gulf Coast, you're directly connected to a premium priced market. And then on top of that, there's some regulatory risk that we've seen recently, not only in and around the DJ Basin, but also in the Bakken. And while that regulatory risk has not yet necessarily directly impacted some of the volumes, mainly around the DAPL decision recently, that is a risk going forward that producers will have to be cognizant of, much like they are in the DJ Basin with the ballot risk and that regulatory risk from setbacks and whatnot really impacting some of the DJ capital spend. And so as we think about how these producers begin to pull activity back, it really starts with the Permian and starts with the Eagle Ford and starts with those regions where, as we model that U.S. refining is likely to lag somewhat the overall recovery globally, the U.S. can still export. And so having that direct connection to the Gulf Coast is favorable for these two basins. And then on top of that, I alluded to the fact that, it depends on not only where these low break-even locations are, but also who has those low break-even locations. So this chart will take a second to talk through, but we've compiled across the major U.S. shale basins. We track undrilled inventory, not only by basin and by break-even, but we also track that by operator as well. And that's also what's featured on this economics view and oil and gas view that I alluded to earlier in the presentation. So as we start to think about the top Permian operators, the top 10 Permian operators, and where they have low break-even locations, this chart illustrates that for the undrilled inventory that they have that breaks even below $50, for the major Permian operators, an overwhelming majority of their low break-even locations occur in the Permian and the Eagle Ford. Those Gulf Coast connected markets that show low break-even locations, and driven by the fact that these are the largest and most active operators, are likely to pull in a significant portion of their capital going forward. And so, as we think about this from all of these producers, there are a number of pure plays in here, but there are several operators as well that show 66, 83% of their low break-even locations in the Permian, but that have assets elsewhere, but don't necessarily have the same draw. Now, this dynamic cannot be said for some of the other regions like the Bakken or like Oklahoma, where producers in those regions, while there are some that show a majority of their undrilled inventory as low break even in that particular basin, by and large, that is not replicated across all of the top operators. And so you have operators, whether it be in Oklahoma or the Bakken, that have more low break-even locations in areas like the Permian and the Eagle Ford. Now, getting into, apart from the fact that the Permian and the Eagle Ford and some of these other regions are likely to draw in some capital, that capital itself is likely to be focused in some of the lowest break-even areas for each operator. And so as we think about how that capital is spread, and if we assume that high grading is likely to occur in these basins, those low break-even wells, assuming that you are focusing on those low break-even acreage, those lower break-even wells typically produce a significant higher amount of oil volumes, and to a certain extent, some gas volumes as well. So these four charts are split across, showing average type curves, average cumulative type curves for the Midland on the left side, the Delaware on the right side, oil volumes on the top, and then gross gas volumes on the bottom. And so as we're just looking at the oil volumes that could potentially come from focusing on these low break-even areas, for both the Midland and Delaware, you have a significantly higher amount of oil that's produced from these low break-even locations. And so from that sub $40 break-even bucket, which, whether you're in the Midland or the Delaware, you do show a significant amount of undrilled locations that fall in that sub $40 bucket. It produces significantly more oil than just the next step lower of that $40 to $50 break-even bucket. And then when we start to think about gas volumes in the Midland, it follows the exact same trend. However, on the Delaware side, it's a little bit more convoluted because when we think about the Delaware, it also engulfs Alpine High, being that gassier area, which from an oil perspective has a higher break-even, but does produce significantly more gas than what I would call your typical Delaware well. But the point being the same, that as producers start to high grade some of their acreage and really develop that low break-even acreage first, for midstream producers, that could mean higher volumes than just if these operators, these E&Ps, decided to complete just an average well on their acreage. Now, turning to the gas side of things here. So as we start to think about, I've talked through somewhat of what our oil thesis is and what is driving that. But the first point that I brought up of the path forward in oil demand globally and in the US, with that path still being fairly uncertain, how that develops and the path that we do find ourselves on has huge implications for what occurs on the gas side of things. So if we see ourselves in a rapid oil demand recovery and rapid economic recovery, which would also in turn lead to a rapid recovery in LNG, we model that there would be a immense short-term need for natural gas coming out of the primary gas plays, because we are currently seeing associated gas declining. However, that need dissipates in 2023 and beyond as the associated gas recovery really starts to gain steam. Taking that on the flip side, if we see an elongated low oil demand scenario where we are showing that oil through 2025 essentially never recovers to 2019 levels now, and that's a deep economic impact from COVID-19 and a lasting economic impact, that essentially flips the script for gas regions. So while we would continue to see low LNG demand and low economic performance, as we start to see even any recovery kind of in 2022 and beyond, that would put the onus on gas producers to really begin to accelerate into some of that growth that we would see from LNG and from some domestic demand in the face of declining associated gas production. So those two scenarios, you can see how intertwined they are really with what the oil story here is, just because of how much of a factor associated gas has become over the last several years. Now, where could that growth come from on the gas side? Again, we have to look to the operators in the regions that show these not only low break-evens, but the ability to grow with low break-even undrilled inventory. And so focusing specifically here on the Haynesville, which we think, given its proximity to the Gulf Coast, its connectivity to the Gulf Coast, especially with some pipeline projects coming online over the next several years, the Haynesville is in prime position to grow into any of the increase in demand that associated gas does not fill. So looking here at the top 10 operators in the Haynesville, based on wells completed from 2018 to present, we show here in the gradient of bars what the average break even is for those operators, and this is something that we've talked through really since I've been at BTU. It seems like a long time, where we always focus in on these break evens by operator and what each operator's decision making is when they decide to turn that new well online. But that other bar to the right is what their low break even undrilled inventory is in the Haynesville as well. So you can see that for a number of operators, we have a significant amount of low break-even locations. And also, when you compare this to other plays that are near the Gulf Coast, the Haynesville does lend itself, especially among these really low break-even operators, lend itself to growing into any of this new LNG demand that we model could come through, because you see other regions like the Barnett, Fayetteville, or some of the gassier Eagle Ford that either does not have the scale to grow into some of that growth, or does not show the same economics as the Haynesville. Now, I've touched on LNG a couple of times here, and we've seen a precipitous fall in LNG demand on the Gulf Coast and in the U.S. And so, while we have come off some of these recent lows, we do still remain at this bottom. So much like on the oil side of things, while a bottom appears to potentially have been reached, especially as we get closer to the winter here in the U.S. And abroad, that path forward is still uncertain, and we model a slower recovery in LNG demand going forward. But that all then impacts into what our views are on the Henry Hub side of things. And so while the LNG demand and the path to recovery there is expected to begin to accelerate and begin to add in some demand and some volumes exiting the US and the Gulf Coast, we model that Henry Hub pricing is expected to increase entering into this winter and really come off the lows that we saw throughout this year. So as we start to get into that recovery and get into the rest of this year, the two markets of oil and gas here, we expect to be highly intertwined. Now with that, I will open up the floor here to some question and answer, and hopefully we can split apart and talk through some one-on-ones here during the conference itself.
Well, thank you, Matt. I really appreciate you and BTU Analytics taking time out of your guys' busy day to come and present with us. A couple questions for you that I specifically have while I watch this. One is, if there's anybody in the audience who's a prospective client of yours and is interested in using this, how do you guys handle all the data with your clients? And I assume they get access to all the stuff you're talking about?
Yeah. So when anyone becomes a client with BTU, they automatically get a sign-in to access whatever they choose to purchase from us or choose to subscribe with us for. And so for some of the data that I've talked throughout the presentation, specifically around our oil and gas view that I mentioned was an interactive platform on our website. Going through our sales team and signing up for that, you can really get access to all this data. And this is data that we've spent now years compiling, whether it be state production data down to the well level, or what we model in terms of production and then economics and undrilled break-evens, all of that data is available on the website there. So, coming through from BTUAnalytics.com and then contacting us to get access to this, you're really open to a whole swath of data. I mean, it's hard to find time to be able to get through it all, but it's fun to work with.
I can only imagine, considering the amount that was in the presentation was really awesome. And one thing that wasn't quite covered in the presentation, I was wondering if you could shine some light on, considering your extensive background, is talk a little bit about the hedging outlook, both for 2021, and maybe there's some operators out there who you think have a more than favorable hedge book, or if you could talk us through what maybe the forecast for some of the hedging stuff looks like.
Yeah. And so, for really the last several years, as we've been tracking this hedging data, normally these small fluctuations in pricing are really what a lot of producers will prepare for, guaranteeing that they have some level of protection against downside in pricing while also giving up that upside in order to do so, has been, more or less fairly run of the mill for a lot of producers. However, when it gets interesting is when we have these steep declines in pricing, specifically now on the oil side. And so what we saw that was interesting is that, as this pricing fell rapidly, it started to really hinder those producers that had really only three-way collars. And so as you think about hedging in terms of, there are, many different methods that you can hedge your production with, whether it be swaps, puts, collars, and three-way collars. Those three-way collars do leave some downside risk to some producers. So there were a number of producers that came out early on in the oil price crash that we saw earlier this year to really revisit their hedge books that they had. But for a lot of producers, like those who had strictly swaps, whether it's your EOG, your Concho, or some other producers that have a lot of just swaps in place, they didn't necessarily have to adjust all that much because they were sitting there guaranteed for a certain portion of their production, a $45, $50 price deck, which, in today's terms sounds really nice. And so those producers that may have spent a little bit more on those swaps are now looking pretty good.
That's very interesting, and I'm sure it's all going to be constantly changing. Final question here. I think coronavirus aside, for all the investors and analysts and everybody sitting in the audience right now, if you could, from your and maybe BTU's perspective, what are you seeing as maybe, obviously coronavirus aside, the biggest theme moving forward here, maybe Q3, Q4 as we move forward into the year?
So looking to, what's really going to drive a lot of oil and gas activity kind of Q3, Q4, is, kind of twofold. So whether we see, cases in the US and abroad continue to remain elevated, and whether or not that then in turn begins to impact, some of the utilization of space in hospitals. That could be that does provide downside risk to some of the recovery that we see ourselves on today. But from an oil perspective, it's looking at, how does the rubber meet the road with these OPEC plus producers? Because the months that we've seen come in terms of data, we have not seen significant compliance outside of your headline countries like Saudi Arabia. So to the extent that producers stick to their agreements, then a recovery could come faster than what we currently model. However, if we do see pricing rapidly rise on the crude side, that may incentivize some OPEC producers and OPEC plus producers to cheat on those curtailments. So really looking to what OPEC does will be a driver of where pricing heads in the near future.
Well, that is awesome. And again, we really appreciate Matt and Matt, your time today. And I'm going to go ahead and turn it over now to the next presentation.
Thanks a lot.